The Datavault AI Inc. stock, ticker symbol DVLT, is currently trading in the pre-market at $1.80 USD, reflecting an early morning move of plus 3.46% from the previous close. Now, what's immediately compelling here isn't the modest pre-market bump itself, but the massive disconnect between what the market is processing today and the truly staggering guidance the company dropped earlier this week. The prevailing market expectation for a nanocap technology name like Datavault AI, one that has a history of high volatility, is usually a slow, grinding recovery from a low-priced base, where any positive news is taken with a heavy dose of skepticism. The reality, however, is that this stock, just days ago, saw its shares move by over 17% in a single day and has been subject to extreme short-term swings, all fueled by a recent third-quarter report that raised the company's full-year 2025 revenue guidance to a floor of $30 million and critically projected 2026 revenue to exceed $200 million. That's not a modest beat. That is an explosive, almost unbelievable upward revision from previous estimates, and the market is clearly struggling to price in that kind of potential velocity, especially for a company that just reported quarterly revenue of $2.9 million. This creates the exact tension we need to analyze: the expectation of a slow, typical microcap trajectory versus the reality of management painting a picture of hyperscale top-line growth driven by a fundamental shift in business model focus toward high-margin licensing and real-world asset tokenization. The immediate stock movement over the past few sessions has been a textbook example of aggressive institutional and retail reevaluation mixed with heavy short-selling pressure. The daily volume has been astronomical, often eclipsing the average trading volume by 2 to 3 times, which signals a massive influx of new capital trying to establish positions. Look at the one-day swing on November 17th, where the stock traded through a 33% range between its high and low. This kind of volatility is typical in situations where the perceived financial outlook for a company changes overnight. Short sellers who have been entrenched in a bear thesis built on the company's historical cash burn and previous business focus are now facing the prospect of needing to cover their positions against a narrative of 148% year-over-year revenue growth and a new $10 million worldwide licensing agreement with Silex. This licensing deal, specifically for monetizing genomic, DNA, and therapeutic data assets, is the linchpin. It provides immediate, high-margin revenue and, more importantly, validates the company's new direction, licensing proprietary data valuation and monetization technologies. This is a far more tangible business segment than the market was previously given credit for, which explains the stock's frantic price action. The technical picture is messy because of the volatility, with mixed signals from moving averages, but the underlying sentiment that the fundamental story has materially changed is overriding short-term technical resistance points. The short interest, which was around 7.27% of the float, suggests that, while not an overwhelming percentage, the volume required for shorts to exit could amplify any upward momentum, creating a potential squeeze scenario that traders on platforms like Robinhood are very aware of.